Hello again, everybody. Thanks for joining me here today. This is Kevin Pierce. I'm with Caldez Financial. Thanks for joining us again on this next episode of Navigating the World of Alternative Finance. And today I'm joined by Robyn Barrett. Robyn is the owner and chief everything for Factor Southwest, a major factoring and ABL shop located here in Phoenix, Arizona. Robyn, thank you for joining us. Robyn also, just in case you hadn't heard, was recently voted one of the top 100 women in asset-based lending by ABF Journal, right? So
that's correct.
Congratulations, Journal.
Thank you very much.
And thank you for joining me, Robyn. I appreciate it.
Thank you. I'm glad to be here and excited to talk about factoring and ABL.
Well, terrific. Well, let's just get started. So we mentioned factoring and ABL. We're going to talk about accounts receivable today. And so why don't we just start in with the big two products, which are factoring and asset-based lending. And for the benefit of the audience, we're talking primarily about commercial accounts receivable, not consumer accounts receivable, which is a whole different subject. But on the subject of commercial accounts receivable, we break them down into two major products, one of which is factoring and one of which is ABL. So can you sort of draw a distinction between the two and tell us maybe a little bit about each and the advantages and disadvantages of each?
Absolutely. So first of all, factoring and ABL are all secured lending. So asset-based lending and factoring are really synonymous. It's just in the way that you do the transaction. So factoring, which used to be a bad, dirty F word, which is no longer, kind of started in the garment industry. So it was usually for seasonality. It was known for businesses that weren't doing well, maybe going bankrupt. So really when you said factoring, people kind of cringed and was like, oh, I don't think so. Factoring has evolved a lot. Factoring is really also now very close. The lines are pretty blurred between factoring and ABL. So factoring, if you want to think about it, is you've got invoices that are earned. You've sent the invoice out, but the debtor or your client has not paid yet. So you're waiting that 30 or 60 days to get paid. In the meantime, you have to make payroll and you have to pay your vendors. So shops will come to us or clients will come to us because they're like, look, we need to accelerate our cash flow. So factoring is a very quick and easy way to do that. The underwriting is a lot less than an ABL. So factoring is really invoice by invoice based. Asset-based lending is really where the lender looks at the entire AR, aging.
As a portfolio of AR.
Correct. So they bring in all of the AR, and then the lender would go ahead and calculate ineligibles and then let the client know what the availability is, which would be multiplied by the advance rate, and that's what they can basically lend against. So again, to kind of take it back, factoring and asset-based lending they're in the same class, they're just slightly different. Again, invoice by invoice based factoring, you don't have to factor or you don't have to borrow against everything. You can just do one invoice, one client. Asset-based lending is you're bringing in all of your accounts receivable.
Okay, so if I have commercial accounts receivable, and let's just say that I don't touch inventory and we'll just focus on the receivables. So I have, let's just say I've got $5 million in accounts receivable from 30 different customers or account debtors, as the lender might call them. How would I make the decision between whether I want to do a factoring deal or whether I want to do this on an ABL basis? What are some of the advantages of, say, factoring? Well, we'll just go through one by one. So spell out some of the advantage and maybe some of the disadvantages of factoring as opposed to ABL.
So I think it really depends on where your company is in the life cycle of the business. So when you're at the beginning of the life cycle and you're a startup and you don't have a lot of financial information, you are definitely a better candidate for factoring. Factoring, there's no financial covenants. And primarily in factoring, we're really looking at the credit quality of the client's customer. So you're a startup, you don't have any financials, you just designed the world's greatest widget, you're selling to Honeywell.
Right.
So you're gonna come to me and I'm gonna be like, you know what, Kevin, I don't care that you don't have financials. All I care about is you've got a great customer, Honeywell. I can credit qualify them, so we can advance against any invoice you send to Honeywell. So it's really easy for companies when they're at that beginning, like start of the life cycle of their business. As a business starts to mature and they've got cash flow, then they're really a better candidate for asset-based lending. Asset-based lending, I think, is for clients that, one, have very good accounting processes in place, because you have to be able to report to your lender. You have to be able to give timely financial statements. You have financial covenants that you have to meet. So I think for an ABL client, it's usually, they're a little bit better in terms of their period in time of business. They can actually be evaluated based on their company and not just who they're selling to.
Okay, so in ABL, just to summarize what you're saying, the underwriting or the onboarding process is going to be more focused on the borrower itself,
Correct.
as opposed to the borrower's account debtors.
Right.
Whereas in factoring, it's a little bit easier for young companies, or maybe companies that have had problems and maybe have a lot of past due AP or things like that, or some other issues on the balance sheet or the income statement that might make it easier to sort of deflect the focus onto the account debtor itself. And the price for that is that they have to do this sort of invoice by invoice, as opposed to being able to just evaluate a portfolio of receivables. Okay.
Yeah, it's a lot more. Factoring is going to be a little bit more invasive. You're going to be required to send all your invoices, your packing slips, your bill of ladings. Because remember, your lender is basically only relying on the credit quality of your customer, and that the invoices that they fund on are valid. And so the ways that you can tell if an invoice is valid is you get the invoice, the packing slip, the bill of lading, and you have to verify with the customer. So you don't give up control, but companies get a little bit hypersensitive when you say you're going to call their customer to verify invoices. That's not going to happen on an ABL line, because again, a lender's looking at the risk, and the risk is, am I going to collect on those receivables? And all I've got are those receivables. If I can't collect on those receivables, then I can't collect from my client because they don't cash flow. So factoring, that's where factoring differs. It's much more, I'd say, it's a little bit more invasive. ABL lending, again, you've got a better credit qualified customer. The lender can depend more on that client's financials and cash flow. So that helps.
Okay, so some of the advantages of factoring just to summarize some of your thoughts, some of the advantages of factoring would be things like a more expedient underwriting process, not as much reliance on on my business itself, and more just on the account debtors. And I imagine there's some pricing disadvantages maybe and some reporting disadvantages. So the factoring, let's talk a little bit about pricing,
Sure.
ABL versus factoring.
All right. Yeah. Factors never like to talk about pricing because we're always a little bit more. So.
Well, you do both, so
we do both. We do.
I think you're okay.
There we go. So I can. We're one size fit all. Right. Again, remember, it's the risk, the perceived risk. So obviously, the more risky the loan, the higher the price is going to be. So when you're talking about risk, you've got a startup company, or like you said, you've got a company that has a hiccups. Maybe the company has a tax lien. You're right. Maybe their payables are much larger than their receivables, and they've aged. Maybe they've taken out some other loans. And so there's other issues that make this much more risky. Factors are super, super good, though, at being able to get in there and at least trying to get a deal some way or another. We're really good at getting subordinations, and, so they can always find an answer, but it's going to cost you.
Right. So
factoring, I would say right now, is going to range anywhere, if you're looking at an APR, is anywhere probably between, I would say maybe 16% on the low end up to 20 plus.
Right.
So.
Right, and these are variable rates, so it would be like a prime plus something, prime plus.
Well, no, so that's a good question, because factoring now, and this is where the line kind of blurs between factoring and ABL in a sense, is sometimes in that pricing. Factoring used to be, in the good old days when I started, a million years ago.
A million years ago.
Yes, 3 million years
Right.
ago, was 1% every 10 days. So, it's pretty easy, and it's pretty easy for people to figure out. And you charge a fee. You don't charge an interest rate. It's a
Right.
fee. Now, I think consumers or business owners are much more savvy. There's a lot more competition. So we'll go out usually on a factoring deal and we're going to price it as, okay, it's 2% for 45 days or 2% for 30, whatever it is. We're going to price it that way. If the client comes back and they're like, well, I really wanted more of a bank-like deal. Sure, you know what? We can go out and we can price it as like a prime plus or LIBOR plus, percentage. We're still going to probably charge like a, collateral management fee. So that's very similar to the pricing structure of an ABL. So that's where they kind of meld. The huge difference, as you kind of pinpointed, is going to be on the actual APR and the fees that you're going to pay. Factoring is going to always be a little bit more expensive, but it's much easier to do. There's not the financial reporting and the covenants. ABL, from what I've seen in the market these days, and it's a very competitive market right now. There's a lot of money out in the market. Banks are going down market into the ABL world.
Right.
So ABL are coming down to the factoring world. So I've seen ABL transactions 5%.
Yeah. Yeah.
But that's really, really low. On average, I'd say for us in our ABL portfolio, the lowest we're going to be is maybe 12 and maybe up to 18.
Yeah, I think there's a clear distinction between ABLs that are affiliated with banks who have access to sort of the lower cost of capital versus the unregulated ABLs. And in the next episode, we're going to talk a little bit about that, the difference between bank-owned ABLs culturally, but also pricing-wise versus an unregulated ABL or a standalone shop. So let's take our viewers through a simple example and try not to make it too complicated, but let's just say that there's a $1,000 invoice, and we'll break it into percentages. So let's say that you've got a $1,000 invoice out. There's an advance rate on that invoice, so the cash, once the invoice is submitted to the factor, there will be cash coming in, and then once the invoice is collected, there will be more cash coming in, but the factor will receive that on behalf. So kind of walk us through that, and let's quantify it in a simple way, assuming that they pay within the 45 days and the 2% fee, kind of presides.
And let's keep it simple, because I think, and this is sometimes the biggest hurdle that our clients have when they first start, it's understanding the cash flow, right, of the process. So you've got a $1,000 invoice, 80% advance. Okay. And let's just assume that the fee is 2% for 30 days.
Okay, so I'm your customer.
Yep.
So I've got an invoice from Honeywell, let's just say, to use a good example. And Honeywell's going to owe me $1,000, and I've given them 30 days to pay. So what's going to happen is, on the day that I send you that invoice and you verify with them that there's a $1,000 invoice, you're going to cut me a check or wire me money for $800, right, against that $1,000 invoice.
Correct.
Okay, then what happens?
Let's take a step back real quick, because it's really important to understand there's two dates in factoring. There's the invoice date when you create the invoice, and there's the purchase date when the factor advances on that invoice.
Okay.
Some ways that clients will save money or in fees is they will hold an invoice. So it's January 1st and you've issued the invoice, you've sent it off to Honeywell.
Right.
You could hold that invoice for a certain amount of days to save money on fees. But let's just assume you send it to me today on January 1st.
Okay, and you said purchase date. So when you advance the funds, you're actually buying that invoice.
Correct.
So you're buying it from me, so you now own that receivable.
Yes, I am going to say yes, and it's a gray area.
Right.
Well, because there's recourse, and I think we're going to get to that in a little bit.
Okay.
But so correct. So I own the invoice now. It's a $1,000 invoice, and it's an 80% advance. On day one, when I verify that invoice is valid, I'm going to send you $800.
Right.
Then I sit and I wait.
Okay.
30 days later, Honeywell sends me a check for $1,000. Okay.
They pay you directly.
They pay me directly. Yes. So now you're going to get the reserve back of the $200 less my fee, which was $20.
Right.
So there you go.
So I'll get my first check for $800, and I'll get my second check for $180. So and then you keep the difference, and that's all. So I'm not paying an interest rate.
Nope.
That goes back to what you said. It's just a fee-based system.
Correct. And I think also for young businesses, that's kind of an easier system for them to understand. The factoring. And I will tell you, for clients at Factor, for startups, or even clients that maybe don't have a good handle on their accounting, factoring is great, because we actually work very closely with our clients to actually help them to be better
Right.
at invoicing, making sure, I mean, you'd be surprised. Does your invoice have a date on it? Don't laugh. I mean, there's
Right.
things. Does it have your name on it? Does
Right.
it tell where the payment goes? I know, and we laugh and we think that's so simple, but companies that are just starting out, they don't have that. So we are a great training. We're like kindergarten. Okay, we're like kindergarten for companies that need to maybe get a little bit of behavioral help, or they need to learn how to work in the world. We're like kindergarten, so they can go off to a first grade or high school, which is an
Right.
asset-based lender or a bank.
Right, and actually, and there's other support techniques that you can offer in terms of credit checks.
Absolutely.
For a lot of young companies may not have the sort of the insight on how to verify that this is a credit-worthy customer, especially for those that aren't publicly traded companies like Honeywell, or if it's just a little mom and pop, there are ways that information that you have access to that they wouldn't necessarily have access to, and that may be one of the other benefits of using a factor.
Yeah.
As well as an ABL shop will be able to do the same, but factors have a direct interest because you don't want to lend or buy an invoice on an account debtor that is unworthy. Well, listen, we've covered a lot of ground today. Robyn, I really appreciate you being here. We will continue this discussion with part 2 of this episode in, how you lend against accounts receivable, commercial accounts receivable, both on the factoring side and the ABL side. Robyn, thank you for being with me, and we'll see you for part 2.
Awesome. Hey, thank you.